Rakesh Arora is now joining us. Rakesh, what do you think markets are trying to factor in with the recent up move? Are you surprised by the up move, the extent in which DIs are investing in the market?
So clearly, this is part of a global rally where risk on trade is on, and emerging markets have been leading the way in the last 3 months. So India, among one of the better emerging marketplace, has been also performing in line. Going forward, it all depends how long this risk on trade lasts. But valuations are starting to get stretched, and we are seeing stocks which have been on the periphery for a long time see a cyclical move up. So I think the rally has some legs, but we are in the last leg, I think.
Right. In terms of the point that you made, some of the stocks which are not done well have started to do well. You think earlier the trade was high P, high growth stocks is what one should look at. Now people are looking at high growth names with low price to earnings or companies where shareholding is not particularly that concentrated?
Yeah, so there have been some stock specific movements where, either there has been some event which is playing out or, but also if you look at the earnings growth which has been projected for FY18, largely it is coming from cyclical names like metals, commodities, Reliance, etc. And all these are kind of low PE stock. And that's why we are seeing a rally in, some of these offbeat names right now. The high PE names, which are the consumption names, they were the ones which are impacted by demonetization. And, there is some competition coming in from players like Patanjali, etc. So that has really cast a little bit of shadow on those names, and high PE names have not been performing as well. But this is too good to last for the low PE names. They are low PE because of some reason, and I would recommend that investors remain wary of buying these stocks at high levels.
Right. What do you think will lead the earnings recovery? Do you think rural economy uptick over there is the key trigger?
No, see, earnings recovery in FY18 is projected to be reasonably strong, coming off a low base of FY17. So we are expecting around 17-18% earnings growth in FY18. But largely, as I said, it's going to be driven by cyclical sectors or banks, etc., which are coming off a very low base. And to that extent, it's a low quality earnings growth that we are going to see in FY18. But surely numbers are start to look better in FY18 as compared to the last 2-3 years.
But do you think the 14-15%, 16% number that the street is expecting is achievable?
Well, see, historically in the last 3 years we have always started with 18-20% growth to fizzle out to single digit. A similar scene can play out in FY18 also, but we are having a very, very favorable low base. So I would say that the probability of that kind of a similar event in FY18 is slightly less, but it can't be fully ruled out.
Okay, then you can at least tell us that is the earnings downgrade cycle behind, because still about last 3-4 years, strategists always predict 18%, 20% earnings growth at the start of the year, and then you start seeing them trickle down towards single digit. You think at least in that manner it is a reasonable number where downgrade possibilities are low?
So, if you look at downgrades versus upgrades, we were already scraping the bottom 1 or 2 quarters back. And it's just that because of demonetization, things have taken a little bit of hit again. But generally, I would say that downgrade cycle is behind us, but that doesn't mean that upgrade cycle is upon us. So, I think already 17-18% growth, which the consensus is forecasting for FY18, is reasonably a little bit of a stretch target. So, I don't think there's a material chance of an earnings upgrade cycle to start. So, the best case is that we meet the expectations which are there.
Right. You think globally people are worried about inflation, what happens on inflation going ahead? You think global inflation coming back will be good for pricing across the board?
So, for countries which are higher in debt, nominal GDP growth becomes more important than the real GDP growth. So, clearly inflation coming back is a little bit of good sign. India also, I think, is reasonably, reasonably placed to withstand these kind of inflationary pressures. largely because of the reforms that we have done on the oil side. So our fiscal position doesn't really get stretched as much as it used to be earlier on. And so a little bit of inflation is okay, but a very high inflation would mean that India would also have to get into interest rate tightening cycle again pretty aggressively, and which will not be good thing. So a mild inflation is what is the best case scenario, and we hope that is what it plays out.
Do you think that cyclical recovery or cyclicals will lead to the recovery, whether you talk about earnings or any further movement in Nifty?
So for FY18, it is forecasted that cyclicals will lead the earnings recovery. However, if you look at valuations, we are already, kind of reaching to the levels which is factoring in that kind of recovery. So, and there are a lot of uncertainties just going to happen in calendar year 2017. One obviously is the pace of interest rate hike by the US Fed. Then you've got Chinese elections. Then you've got few European countries going through elections. And so it's not going to be, a cakewalk for the Indian markets, and especially for the cyclical companies. So my stand would be that, if you're holding on to these names, maybe, ride it for another 1 or 2 months and then look to pair exposure because there's a lot of uncertainty beyond middle of 2017.
Right. In terms of global risk, you think that's one of the biggest risks for the market? You started by saying that markets are in a risk-on mode globally. They turning risk-off would be one of the biggest risks for India as well?
Meaning surely, I don't think domestic economy is doing anything spectacular. Meaning post the demonetization, we're just getting back on track. And we are looking to healthy 6.5-7% kind of growth for currently, which is something which is good enough to put markets into the next level of valuations. So it is just the funds flow which is going to really drive the Indian markets in the near term. In the last year or so, we have seen domestic fund flows has been supporting the Indian markets, and if the FI also turn positive, then this rally can get extended. But valuation wise and fundamental wise, things are starting to look slightly stretched already.
Right. Can you just tell us that in terms of DII flows that you just mentioned about, do you think it's sticky in nature? Have you done any analysis which suggests that this DII flow should continue?
Well, see, theoretically speaking, given what government has been doing, the avenues for investing for a reasonable return are drying up. So whether it is real estate or gold, and that leaves stock market as one of the key areas where retail money is going to flow. In 2006, 2007, at the peak of the bull market, almost 8% of retail investment was in financial instruments like stock market. Currently, it is around 2 to 3%. So there's still a long way to go before we can say that the retail inflow have peaked out. And if it is a structural change, maybe it can last for much longer. So there is definitely hope that domestic inflow of money into stock market will continue. FI inflows have been negative for quite some time, and so that is where the variability comes in. If that also turns positive, then the Indian markets can go to a much higher level. So currently they are trading at 17.5 times FI18, but historically we've seen that it can get stretched up to 19 times also. So another 8 to 10% up move can't be fully ruled out, but it will all be dependent on funds flow, largely FI fund flow.
And Rakesh, in terms of the valuation multiples that you just told us, 16.5 times is not cheap as well, right? So any sort of negative news, whether it's globally or locally, and markets could react sharply.
You're definitely winning. That's the big risk. That's what I was mentioning, that the cyclical sectors will face some challenges by middle of 2017 when elections in China are due, and there could be a lot of hiccups. So during that time, I think correction possibly can happen, and investors would do well to book some part profits on any kind of upticks in some of these cyclical names.
Right. What do you make of movement in telecom, movement happening in airline sector? Do you think it's surprising, or it tells you that liquidity flow is too high and people are just looking for ideas to search?
So telecom, I think the positive surprise was that Reliance Jio deciding to, charge the customers, which was slightly ahead of what the street was anticipating. So to that extent, there was a positive announcement. And prior to that, we also saw some news on consolidation in the sector with Idea and Vodafone in talks with each other. So these are positive movement for a sector which was in a structural decline, and maybe it's too early to say whether things are bottomed out and we are out of the rut, but clearly there's a little bit of a bounce which is happening. Airline stocks, I think, are inversely correlated with oil prices, so they would move inversely proportional to that. Notwithstanding the news that one of the largest investor globally has changed its view on airline stocks. Maybe that might also be helping right now.
Let's talk about the entire mid-cap space then. Are you surprised by the mid-cap market, the sustenance over there in terms of valuation? Even if you look at the earnings of the mid-cap companies, at least the one from the index, a large one of them continue to show strong YOY growth as well.
So I'm not surprised at all. I think mid-cap will continue to do much better than large caps even for 2017. And this is driven by the fact that bulk of the retail money which is flowing to either mutual fund or PMS schemes, etc. These funds normally tend to do bottoms-up approach and tend to be stock pickers. So clearly the benefit would go to mid and small cap companies. And I think this trend will continue by and large in 2017 also.
Right. Amongst the mid caps, what are the names that you like? Do you think there is scope for outperformance in any of the pockets in the mid caps?
See, I won't be able to put names there, but generally speaking, one has to look for specific themes to play out these mid caps. So whether it is a consumption theme in India where some brands starting to do much better, or is it NBFCs who have a niche space in this whole financial system. So there are a lot of opportunities in consumption, NBFC space, infrastructure space, which is where I think government investors should focus on for 2017.
What NBFCs do you like? You said niche NBFCs. Which ones are you talking of?
So, one of the key focus areas for government is low-cost housing, and the NBFCs which are into that low 5 to 15 lakh house loan segment should be the ones should be doing much better. Secondly, we are also expecting two-wheeler growth to now pick up. So some of these two-wheeler financing companies should also start to look better in 2017.
Right. What about the banks then? What would you do with banks? You said that you expect earnings outperformance to come in from the banks because of a low base. We're not seeing signs of a credit pickup. What will lead to this kind of outperformance? Just the low base?
So banks, obviously there's been a category of private banks versus PSU banks, and everybody has been favoring private banks, and that is getting reflected largely in their valuations. I think for PSU banks to perform, government has to act really fast for the NPA situation. And from what we understand is that they are doing meaningful round of discussions to solve this issue from its roots. So I think if there is some kind of opportunity that is largely in large PSU banks and some of the corporate facing private banks. So I think that is the space where there could be further re-rating. But private banks largely look to have run their course, and I would still avoid small PSU banks because government may not really come in to help and infuse funds for banks which are not doing that great. So large PSU banks and some of the corporate facing private banks are the ones where there is an opportunity.
But there is also talk of consolidation amongst the smaller PSU banks that have been suffering. Would you try to play that opportunity as well?
Well, so doing a M&A kind of call is extremely difficult until the time there's some stock-specific news. The risks are too high, so it is better to stick with large quality, larger PSU names, because they will the one who will eventually benefit from any kind of merger also. So I would avoid looking at very small PSU banks.
Said you avoid the smaller PSU banks. Now, you said amongst the mid-caps you like some consumption themes. Can you elaborate on this? Because some of the larger consumer names are in any case trading at very high valuations. And you seem to suggest that at the valuations that we are trading in now, the scope for a PE rating is not that much. So how do you pick amongst the consumer names that you think will do well?
So, large cap and consumer names have been hit on two accounts. One is because of the rise of Patanjali, which has come as a credible, competitor. And number two is that there's some rise in commodity prices, which is hurting their margins. But, there are niche in consumption space like apparels, like, fitness. So these are spaces where there's limited competition, and if you have a niche brand, companies can grow at a much faster clip of 20-25% in the foreseeable future. And some of these stocks are not as expensive as the large cap FMCG names. So this is where I think one should focus on. And the tail is pretty long in consumption stocks, and there's a lot one can choose from. And because of demonetization, the valuations have also come down for some of these companies. So that's one area where one can find quite a bargain.
Bargain can be seen in some of the consumer names. Rakesh, what do you do with the oil and gas space? Reliance has seen a big breakout today. It's up 5%. What do you do with the oil and gas names, where even gas stocks have done very well? Do you think there's scope for more?
Well, see, Reliance has a lot of things working for itself right now. So their capex program is coming to an end, and the benefit should start coming in from FY18 onwards. Plus, Reliance Jio, which everybody has kind of written off in terms of investment, can start to break even if they are able to retain large part of the consumers that they have been able to sign up. And so overall, I would say that the stock, having done nothing in the last almost 7-8 years, and now all this capex is starting to add to their earnings. Maybe it is time to go a little bit overweight and ride the earnings growth which is likely to happen.
What about the gas names like IGL, Petronet? Both regasification as well as city gas distribution names have seen a lot of action. When you look at global crude oil prices, they've moved up, but they don't seem to be shooting through the roof because data is showing that fracking in US is picking up again. What's in store when it comes to gas prices, and what would you do with some of these gas names?
So, city gas distribution companies look better because they are doing abnormally high returns at the moment. And for any utility company like that, the returns are really, good. And compared to what any investor can make in most of these debt instruments these days, I think they are looking for yields from utility companies. And that's why you have not only gas pipe companies, but NTPC, Power Grid, all doing really well. So these are kind of proxy to play a kind of debt market, and I think this trend can continue for some more time, given limited options on debt side.
All right, Rakesh, thank you so much for speaking with us at NDTV Profit, giving us all the ideas and the themes that you like for investing in the market.